key U.S. inflation report and the Fed's interest rate decision are closing in. The dollar index and bonds yields eased slightly yesterday, yet in the absence of excessive volatility, their respective moves also point out a rather indecisive market. In this report, we aim to shed light on the catalyst driving the precious metals price, assess its future outlook, and conclude with a technical analysis. The U.S. Consumer Price Index for November, the final report for 2022, is due out later today and is projected to showcase that inflationary pressures within the U.S. economy are slowing down. More specifically, the headline year-on-year CPI rate is, according to estimates, expected to ease to 7.3% from the 7.7% recorded last month, and the month-on-month CPI rate is expected to record a drop to 0.3% compared to 0.4% of the prior month. Similar drops are forecasted to take place for core CPI rates as well. Should the actual rates meet the aforementioned expectation, we may see the US dollar facing further headwinds, since such rates may solidify the market's expectation for an easing of the Fed's rate hiking path. On the contrary, we may see gold prices receiving support and capitalize on the negative correlation between the dollar, as lower rates tend to be beneficial for the bullion as it decreases the opportunity cost for holding the non-yielding asset. Even though the projected results serve as good news, indicating that consumers' purchasing power will be granted more breathing room from cooling price pressures, the rate still runs at about 3 times more than the central bank's 2% target. Despite hovering about the target, a downtick of inflationary pressures one way or another justifies the Fed's projected 50 basis point hike decision, which is set to slow down from the 4 consecutive jumbo 75 basis point hike path if it so undertook so far. Should, on the other hand, however, we observe an upside surprise of the inflation rate, we may see the dollar rise substantially and gold prices to contract, since a hotter than expected inflation print will put more pressure on the Fed to extend further its monetary policy stance. Tomorrow, Wednesday, the Federal Reserve is to announce its latest round of interest rate increases. The central bank is expected to deliver a 50 basis point hike in the December meeting, raising the Fed's target rate to 4.5%, a whopping 4.25% cumulative tightening in this year alone. The Fed's fund futures currently imply a 91% probability for this scenario to materialize, yet we patiently await for today's release of the latest inflation report. The market appears convinced that the committee will raise its benchmark rate by 50 bps, and most analysts thereout say that the move is already priced in and should bear no reaction. What is of particular importance, however, are the contents of the Fed's forward guidance contained within the FOMC statement following the decision, the renewed dot plot, which will shed light on where the bank's officials see the terminal rate being in a year's time, as well as the highly anticipated speech by Fed Chair Powell. Market participants currently forecast that the Fed's terminal rate will peak at around 5% by the end of the first quarter and will start to fall as the central bank pivots and start cutting rates near the end of the second quarter, since they estimate that inflationary pressures will abate and fall closer to the bank's target range of 2%. Also of crucial importance will be the vote count from FOMC members, which should indicate a severe split among its members. There might be signs that the bank is facing internal problems and may pose as a credibility concern in the eyes of the market. Thank you for watching.